Good afternoon. Good evening. Welcome back. Sorry for the late start. We got a lot to talk about. A lot of stuff going on this week on Twitter for sure, in the markets. Crazy markets past couple days. So I'm going to get my coffee. Oleg, you are requested.
Oh, hi everyone. Hi Jerry. Hi Brian. Hi Bruno. Hi Richard. Hi Absolute Alip Cardura. All the guys I can see here, as I was always my traditional greetings, I think. Hi Moritz. I'm very happy to see Moritz always. Because I have a habit, and I still have this habit, to listen almost every day something from systematic investors, especially when it was there. Jerry, Moritz, and Niels, and I listen this wisdom, and I have this habit because there is such a practice named golden hour, and the sense of it that if you want to be a master in something, you must listen for an hour or maybe 30 minutes at least a day, something that is important, really important for you, something from your field. And so my golden hour is something from Jerry's wisdom and from also Maritz and Nils quotes and these conversations. And I keep learning. And I force myself to. I'm very happy to do this, but I force myself to learn, and almost every day I do this. Even if, especially by the way, when I'm in the forest, I concentrated on my thoughts. Now I'm back in Novorossiysk, but also very focused and concentrated on our trend following philosophy. And I think that if you're a trend follower, it's not only success you will be not only successful in your trading activity. I think a person with a trend following mindset is a successful person in general. It's a happy person, a successful person, because it really gives a lot of happiness, this philosophy, a lot of happiness, a lot of true friends, a lot of people, inspiring people, inspiring learning materials or something like that, that inspiring philosophy. So I'm very happy to be here, as I always say, in our trend following trading ideologies weekly meeting. Let's get started.
Oleg, Jerry, everyone, hello, how are you? Look, it's been a fairly busy week for me. Jerry, I was following your tweets. There was a couple that really stood out to me. One was that excellent tweet from Morgan Housel, which was talking about the difference between intelligence and smart. And that was a great article. He's really got the gift of explaining things and in novel ways. And I really enjoyed that article. And the other one that really hit me with a bit of a surprise was Mike Harris's price action blog, calling into question the use of the sort of lack of uh, interest in the Sharpe ratio by the trend following community. And just the way he expressed his post came across as a bit of a slap in the face, I personally think, for trend following. But he said he was giving an unbiased viewpoint, a more balanced viewpoint. But I just feel that the way he described it was perhaps totally going in the other way, to provide a very biased viewpoint from his perspective. But I'd be interested to know if others had read it and their thoughts regarding it. But I hope you're all good, Jerry. How are things?
Things are good. So I thought that article. Oh, then there was another article too that was really good that we should talk about. That was concerning, from a sort of a different perspective, the importance of trading more markets, more stocks in particular, the research piece was trading 200 or 300 stocks was a good was better than trading sort of the number, the lower, much lower number of that sort of traditional statistics, and he was calling into question using volatility as your main or sole criteria. So I thought that was pretty interesting as well. But yeah, I think Mike is picking up a lot of quotes from me, then throwing them in these articles, and then telling everyone why he doesn't think that all of those things are correct. So it's pretty interesting that he's doing that. But I guess I do agree somewhat, even though I'm trying to choose my words carefully here. I do agree that when you don't use, the sort of closed trade equity realized balance that we use, when you don't use that as your trade level, when you do use current AUM as your trade level, and when you use a dynamic position sizing and vol targeting and correlation management, I do think that it's probably a decent idea to utilize the Sharpe ratio, because you are sort of in the you're in the category like all the rest of the world that they're certainly paying attention to Sharpe, even though on Niels's podcast they kind of all downplayed Sharpe. I think that they're right in the Sharpe category, in the Sharpe camp. I think the point that, and Mike sort of says, does CTAs or win CTAs? And like we've said before, the classic trend followers who don't do those things, it's like 5 people total, 5 or 6 total traders that I know about. And so we don't use Sharpe. It's not, we don't think it's relevant for classic trend following because we let the profits run. We don't use current AUM for our trade level. We don't use the dynamic position sizing. So in that regard, I think that he didn't bring that point up. But of course, we're not limited on clarifying what he left out. So I think to some degree he is bringing up a very good point that it is Sharpe ratio might be good and reasonable for people who pay attention to volatility, and they all do by definition. That's managed futures. They shouldn't. That's what we've said. Don't pay attention to volatility. Free yourself from this prison of Sharpe and this prison of volatility that you're targeting and that you're trying to solve for, and go back to being a classic trend follower and do the money management properly with by not using the current AUM for your trade level, and then you can not have to worry about the Sharpe. And of course, my whole idea is that in that particular way, the way that we do it, Sharpe does not translate into loss of capital. So a lot of those good points he kind of left out, but it wasn't like it was all bad. He trashed us or me in other ways we can get into, but I think, and there was another article as well that I tweeted about last night, but I think that the Sharpe ratio is not something where any of the classic trend followers need to worry about. It doesn't translate into capital loss. I mean, that's the bottom line.
And I want to say that before talking about the Sharpe ratio, every person, every investor, before they say that it's very good thing to measure your risk, I think every manager maybe he must think about what is Sharpe ratio is, what the story of Sharpe, and so on and so forth. And on the other hand, he must think what is our transforming philosophies, what is our methodologies, or maybe not our philosophy if he is not transforming his philosophy. And I think that is this good match for this, and like Richard Brennan always said that this Sharpe ratio is a linear measurement non-linear system, for non-linear in general, for non-linear world. So it's only people only it's false expectation. It's really false expectation that gives the people. It's a psychological commercial moment, I think, that it's a tool for marketing, and we always say about this, but it's really so because it's only psychology here that people see that it's a measurement of risk and they think it's a good measurement, but they don't think how it actually works and why somebody calls it a measurement of risk. And I think it's a big problem. Only this, because it's not a good measurement, and if a person will use his logic and will pay attention, dedicate some time for.
Did you want to comment on that, Richard?
Yeah, well, look, the first thing I'd like to say is it irresponsible of industry to use Sharpe as a measure for risk when we've had examples of firms with exceedingly high Sharpe, like long-term capital management, the methods deployed, such as martingale methods, which over 3, 4, 5 years can produce fantastic Sharpe. And yet industry at the same time demand that at the bottom of all of the information releases to the market, we have a little statement saying past performance is not indicative of future results, and talk about the risk statement when the entire industry is supporting this retarded concept of risk being volatility. So, in an angry way, that's what I'd like to say, Jerry. I'd like other people to comment.
Yeah, another point brought up was that we should pay attention to it because clients pay attention to it, which is true, But there kind of needs to be two parts of our brain analyzing this. One part is on spaces, and Michael might be a PhD as well, so he knows full well that part of his brain is analyzing and backtesting and using his math and science to determine what to do and how to do things. And then number two is full well acknowledging that paying attention to things that clients pay attention to help people raise money. I just think it's, but to sort of end the whole missive with the fact that clients pay attention to it. You have to pay attention to it. This is the end of the story. That was strange coming from him.
Yes,
Well,
but
not only that, his focus was on Sharpe, and then he said, well, in the absence of Sharpe, the CTAs like to use Sortino. Well, that's a crock because, or we insist that path-dependent metrics are what is necessary to express our philosophy. And the entire industry devoids the role of path dependence in any of their economic models. So, in a way, it's supporting a legacy that I thought was outdated in 1980.
Hi guys, hey Jerry, hey Richard, hello everyone. Yeah, I mean this Sharp thing. I recently had a conversation with someone else in London, and I asked him. So it was a big firm. They got a lot of traders like myself, and they were providing this regulatory umbrella services. So in London, it is pretty easy to get regulatory compliance because there are more than 30 different umbrella companies. So you go through them, you pay some money, at the beginning they charge you little. So what happens is, and these businesses have established clientele. So, one way of getting into the money management is through them. So they sort the compliance side of the things through a fee, and you need to go through the documentation, and then they introduce you to their existing clients. Now, the conversation is always, their best, what they do. But I've been told the best thing is 10% maximum drawdown. If I can get to it, it turns out to be the best way to to make the strategy palatable for a lot of people. And I was thinking, who is the most famous person that I've heard in the managed futures who uses this 10% maximum budget rhetoric? It's Eric Crittenden. I was listening to his few podcasts too, and he keeps on
It's
getting back
Bernie
to.
Madoff, Alp.
Yes, you might say that, but I think standpoints. Specifically, Jerry mentioned that Eric is his friend. So Eric Crittenden is having this 10% maximum drawdown budget. And in his podcasts, he mentioned that 10% maximum drawdown budget. And even I was watching Tom Basso's tweets, and he was talking about 5% maximum drawdown. So, it would be interesting to, invite Tom or Eric into here when, Jerry would find it appropriate. But it would be interesting to pick up their brains. One of them is saying 5% maximum drawdown, the other is saying 10% maximum drawdown, and we are saying, there's another world. So why happens? Because there's a distinction between being a trader and being a money manager. When you're a money manager, you work in an industry, and I guess the Jerry Parker's success cannot be replicated today without actually being doing what the Dunn Capital is doing through his volatility and correlation management, or through standpoint through their volatility management and correlation management, and throwing in various additional strategies to make it more palatable. So basically what I'm saying is, Jerry Parker cannot be the Jerry Parker. He cannot make the same amount of fortune today with the with what he is doing. So it worked in the past, but it's not going to work going forward. And the choice is, there's a choice between a trader and a money manager. And the money management is managed futures, no doubt, because the clients are there, the committees are there, you know, and I was tweeting earlier on about, you can manage money for your friends, okay? It's a possibility, Someone else said that, okay, I know for 5 years, I'm going to give him 1 million to manage. So you can make, you can make a living out of it. But if you want an institution, let's say an insurance company to come to you, or a family office come to you, and I'm not talking about the small and the medium guys, the large ones, the larger ones, then you need to go through this checklist. That checklist, there is something else. There's a checklist. I need to have, one of the things they look is the number of people that are working for you. It starts from there. You cannot do it with a one person or two person. You have to have a team for this dedicated. Then of course your sharp is going to be observed. If you want money from establishment, you have to play the game that establishment requires you to do. And it is a choice, because I'm a short-term trader and I can do what, my systems can do what they are asking to do. Of course, I'm not doing it because I'm a trader first. And, I clearly would like to do my own thing rather than just stay in the domains that have been described by those people. So I am saying no, I'm not going to play the game that the establishment wants me to play. I'm not going to code mean reversion on top of my trading trend following strategy, which I could, and it's not very different. The code that I do have can easily be converted to mean reversion. Then I can add the other momentum, the relative momentum, Then with those three strategies, the drawdown is going to be much more smoother. But there are costs with that. It's all about, there's a big difference being a businessman. Jerry Parker talks about, I'm a businessman, that sort of thing. So I'm not a businessman at this stage. Now, I'm a trader. I'm a new trader. So I've got no interest being, playing the game that the establishment wants me to play. So there are consequences. There will be consequences for that. I will be small forever until I play the game that they want me to play. But so be it. But that's where I am. Thanks.
Hi guys. I also wanted to say that these days you're competing with the buy and hold having just 20% drawdown on the last 15 years. So and that's without any interest rate carry. So many people are starting to think that, but the very small drawdowns are feasible because you can have a relative small drawdown without doing anything, and that's something that weighs on those minimum drawdowns requirements. I think because there's been no 50% drawdowns in any of the more important markets, for almost 15 years.
Yeah,
And they never learn. We never learn from history in these regimes like pre 1987, 88, where we had a decade of the bull market of equities where there were very little drawdowns over that period. And we never learn. We just go back into the same cycle of being caught by these, these significant crashes. Industry is just retarded in their acceptance of how to measure risk.
they, in the article, it says that CTAs have had a worse performance than the stock market, which is not true over all the data. Just over that period where Fed dominated and rates were really low, and as soon as that ended, CTAs did really well. Those 20, 21, and 22, and then prior to all of that, 2009-ish, CTAs did really well, and then I don't think CTAs or the main CTAs ever had a lost decade where they didn't make money for 10 years. I asked that question on Twitter. No one bothered to really take it seriously. Yeah, so I think CTAs, with all of their markets and with all their systematic approach, have a much higher likelihood, as demonstrated, to make money like they have in the past, and they will in the future.
Jerry, here's a question. Have we ever had a 92% drawdown? Like, as far as I'm aware, the NASDAQ is an equities index, which had a 92% drawdown between 21 through to 23.
Well, as I've said many times, I don't think any CTA hardly that does trend following that trades 30, 40, 50 markets probably can have as bad a performance as averaging about an 8% return and over a 50% drawdown. It's just kind of impossible given all the markets, trend following strategy, and short trades as well. Oh, this was the part I forgot I wanted to say that was kind of humorous. That is, see, more things keep popping in my head. I don't know which one to say, but it was kind of funny that one of the things that was said in the article was that, okay, yeah, so stocks do have 50% drawdowns or 60% drawdowns or whatever, but those are great buying opportunities. Why?
And you should martingale into them. I can't believe that from someone talking about risk.
Right. Why were they good? Why are they? Why were they good buying opportunities? Because the market went up. Okay, that's wonderful. That's perfect. The market went up after all of those drawdowns. That's great. Yeah, so did the CTAs. They always recover. So it's really humorous. Anyways, I wasn't just getting criticized from Mike Harris. I also couldn't help but think that maybe one of my friends in this industry was talking about me on this podcast when he says, quote, some of our best friends in the industry have decided to stay with what they've done for the past 3 to 4 decades and not deviate from that philosophy that they were taught. But as researchers, we should continue to be open-minded. CTAs bring in researchers with different backgrounds and give them freedom to try new things and then maybe come up with something that can convince or compel the approach to be changed. Yeah, I mean, I'm sure that that's true. They do. They bring in other types of researchers. They don't really need to because they have these bad, evil thoughts in their own heads as well. I'm pretty sure to add negative skew stuff to their trend following and to water down their trend following by coming up with what they consider to be valid rules that cut profit short. I will say though that when it comes to my changes and my evolution and the things that I want, that I think are important, and the ways that I have deviated from my beginnings, none of those are legitimate. Oh no, no. They are discounted. In fact, we'll have whole podcasts on why you don't need to trade stocks. Trend following on stocks doesn't work, even though they all trend follow indices. What? And so my ideas of long short equities, that's another thing that Mike said, is that one of his ideas was, what, you trade short stocks? I never knew that Jerry traded short stocks. Oh my God, these podcasts are so frustrating because I have to continue to repeat myself over and over, and it still does no good. No. So my changes, adding markets, adding stocks, they're discounted and they're criticized on these very same podcasts. Every CTA in the industry is asked, why do you really need to trade all these stocks, blah, blah, blah. But adding these regrettable features that reduce sample size and bastardize trend following, well, this is the type of evolution that's acceptable. This tribe of theirs, who I'm not a member of, is very particular who they let in and what you can say and what's acceptable. And so, unfortunately, all of my great ideas, all of my changing, trying to become bigger and better, not so good. Their ideas, very, very good. I should not be so close-minded. So I'm close-minded.
And I want to say only that buy and hold, and I have said this before many times, that buy and hold strategy looks worse, way worse than our strategy, even for a person who is not an expert. Because really we have this 8% average profit and 50% maximum drawdown. It's enormous. It's enormous, and there is no, it's not robust. It's not, in fact, it's not a system. It's only a narrative without any foundation, without a base. And I liked when Mike Melissina said that it can be the performance can be the same for maybe a year or two, but when the harbor in New York will be frozen, the performance will be very different, and our CTAs will be in a good profit, and buy and hold will be in a not very good situation. And I think you must not be an expert in this field, in the investment field, to understand, to see this. It's very simple to see that, and as I have heard, that 75% of investment in the world is buy and hold investments. So we have room for our trend following investment. I think from a part of these investments, at least a part of this, maybe 10, 20, 30% of this must be an investments of our trend following funds. And it's a pure logic, I think so.
Just quickly before I let others chat, Jerry, it's time you did another podcast with Mike Melissino, because this week I was getting a bit depressed, and I wanted to look at an updated podcast with you and Mike because it makes me laugh a lot, and they're great podcasts, and I'm just hoping you do one again very shortly.
Yeah, well, hopefully we get it done today. My schedule is a lot less packed than Mike's. So Mike works for me, and he has a young child, so he has a lot of work to do. But hopefully we get that done today. We usually do it Friday, right after this, and so hopefully we can get it done. I'm always making tweaks to my approach, my system. So I think I'm going to hold off on any tweaks today so we can get, I'm joking. I don't make tweaks. I add stocks, yeah. So I'm not quite finished adding stocks. But Richard, importantly, you have your own podcast, a new one, which I am equally as excited about. And I think I'm really happy that you started that. And I want to hear more about that. What do you hope to accomplish? And how do you expect this one to be a bit different than, for instance, Spaces or Top Traders Unplugged?
Well, what we're doing here is we're putting a mean reverting trader in the room with a trend follower and seeing how that goes. So that's going to be a joy. And look, Simon and I get on very well. We come from diametrically opposed viewpoints, but I think that it makes a podcast interesting when instead of just nodding your head and accepting what's being stated, there's challenges going on all the time. And so look, we're not going to be confrontational to guests that come on, but we're certainly going to do we're thinking of doing debriefs in the following podcast after a guest, where Simon and I will chat about the ideas that came up from that podcast. Also, we propose to sort of go down more sort of instructional courses on how to do things rather than just talk about the theory. So, we've had a chance to at least give a guideline on the philosophies that Simon and I adopt in the first two, and then we'll be introducing guests in, and I hope to be drawing from a lot of you trend following guys in as guests on the podcast. What I'm trying to do, and this is where I don't like what's happening with the statements by industry that we're backward in nature or living back in the 80s. I actually think from where I'm going in my research, it's justifying that the classic way is actually the modern way to approach trend following under uncertainty. I want to restore that through a different approach to viewing these markets, a more what I view as a contemporary approach, as opposed to an approach that has been pretty well defined by economics over the last 50, 60, 70 years, and they're just refusing to let go of the use of their particular type of statistics, the use of their particular type of metrics. I want to sort of challenge that whole notion with this sort of growing research into complex adaptive systems, how to approach uncertainty, why classic, and why the things that people say is so outdated from us, the use of stops, trailing stops, small bet size, massive diversification, the things that we typically try and sort of reach to the audience. I want to give a more scientific bent for exactly why we adopt that, as opposed to just a statement. Give some backing to it, give some substance to it, that there's very clever ways how these things have grown from experience by practitioners who have done this for so many years. Now, they might not necessarily know fundamentally from science, because science has taken a long time to be absorbed by economics, but they've adopted these rules, these principles from their deep experience. What I want to do is, from a scientific view, give substance to those rules, why it is so important. So hopefully the podcast series allows us to go into lots of debates, lots of challenges, introducing new ideas, new models, new ways to look at the market, and hopefully that builds the strength of the classic methodology.
Hi guys, can I ask you a stupid question? Spaces, podcasts, ETFs, etc. Aren't you afraid that this thing will be popularized so much that will be hurt in its performance, or do you think that cannot happen?
I personally think that once again, here's another enigma. Most traders, predictive traders, dealing with convergence systems, are dealing with the law of diminishing returns. the 10% like us, we're dealing with a different law, the law of increasing returns. The more that we get people flowing over to our method, the more it amplifies the signals. So I'm totally opposed to the view that there is a one-size-fits-all for this industry, and statements such as the more competition we get in trend following, the less edge or the less alpha we're going to get, I think are just totally wrong statements.
I saw that tweet. I think you tweeted that earlier this week, Cordura. And it's an odd thing to tweet and to bring up because we just got finished saying, and we're sort of all bemoaning the opposite of that. Although I am interested, I do think it's an interesting subject, but in every spaces we talk about the opposite of that problem, which is no one loves us, no one likes us. It doesn't. It's almost like the opposite. The more we talk about it, the more we're disliked. The more they put out these half-ass articles that are not that are misleading, don't have much truth to them. The more our friends in the podcasting industry mischaracterize what we say and come up with these one-sided articles. And not only that, but when you tweeted that earlier this week, I thought it's not only that Richard Dennis said you could print the rules on the front of the paper and no one would follow us. I think he meant it was because it would be too hard to do. But I also think now it's because people would say, no, it's all incorrect. Your track record be damned. It's all incorrect. And there's much better ways to do this. Then take it to a third level that we took it to recently, where I personally put all of my positions on the internet every day, and no one cares. No one bothers to look at them. No one's copying them. This is this incredible information, a culmination of 39 years of trading and research. They're all right there, and no one looks at them. No one knows. No one knows I'm short stocks. Well, not no one, but certainly people who write long articles, they don't pay attention, and so there's nothing of value. That people don't perceive any of this as of value, and primarily, I think, because it's. I look at what I do personally as being very close to what the S&P does. I think what I do is beta. It is an index. It's out there for everyone to see advantage of. It's very. I think that people are. Thank you. Trying to they don't like it. They'd rather they want to get. They're obsessed with getting rid of these drawdowns, and so we embrace the drawdowns, and we sort of say, at least I do, that in order to make good money and to have a robust system, you have to have these big drawdowns. So yes, if human nature changes, I guess, and they all see the value of big drawdowns, letting profits run, and giving back all the profit that you've had because you're using a breakout system that will absolutely give all the profit back very quickly, unless you intervene with a illegitimate exit method. Then maybe people, if they get that far, maybe then someone will say, I'm going to be longer term than that. Okay, I'm waiting. I'm waiting for me to win psychologically and intellectually. This is a day that not only am I not fearing, I'm looking forward to it. Where then all of a sudden everyone agrees with me. I just I'm not holding my breath.
And I like the idea of Niels. Niels once said that, maybe not once even, that it's trend following will never maybe be overcrowded because it's hard to execute, it's hard to do for people in a psychological way. Because this drawdowns, this it's maybe I think in general for people it's not easy to be consistent in modern society. I think it's not easy to be consistent. It's not easy to be contrarian, anti-conventional. People like, as also Neil said, that people prefer to fail conventionally than to win unconventionally. People like to be with the crowd, and I think that it's not. I agree with that our classical transforming approach, and maybe even every business which is done in a profitable, good way, in a classical way, will never be overcrowded. As one business coach said, that every person knows how to be fit, but a lot of people are extremely heavy weighted in the US or across all the world. But every person knows the recipes of diets, knows what to do in gym, and so on and so forth. So the execution is a very, very important thing, and consistency in this execution, a discipline. And for me personally, I say everyone, the lack of discipline and consistency in people, in people's mind had human bias, I think.
Try to
Boy, I think
maintain my composure, and I cannot do it. I just get too intense on these podcasts, and this is what happens on the on Spaces. This is what happens on podcasts as well. I try to be calm and relaxed, but I get too excited. Well, I'm really interested though in Moritz if he has any comments on this.
So consistency, I think, is super important in so many facets of life. It's not only trading; it's very financially important when it comes to trading. Consistency means that we're not changing the rules all the time, that we're not changing course, that we're sticking to the rules that work. You know all of that, but you see the same thing, the same pattern in really all sorts of things that you do throughout the day, throughout your life. I enjoy playing tennis. To give you one example, I'm not on the ATP tour or anything, but to win matches, it's avoiding unforced errors and it's playing consistently. You have to be on the court and just be very consistent. Don't get too disappointed. Having errors in your game is part of the game, but stay consistent. It's true in golf. The best golfers in the golf club down here, they don't have the most beautiful swing. They don't drive the ball the fastest or the furthest. They play very consistently all the time. They're very focused all the time, and they just repeat, repeat, repeat. And they're also patient. And that is something, by the way, that took me a long time to really learn, and it's probably still a learning process. But patience is another thing. When we as traders, as trend following traders, we have to be super patient, like almost the most patient people in the world, because we have these periods where you can kind of like kick yourself because the P&L doesn't come in, and you look at other people, you look at the S&P 500, you look at the hedge funds, and they're making the money, and you don't. You're kind of like just sitting there. You're making no money, or maybe you're making a loss. But I found that you need to have that tranquility and the patience to keep going, and then you will be successful at the end of the day. But having this, and this is why I agree with Jerry, and also what Richard has said, is he can put the rules in the newspaper. Jerry is putting the positions on the web, on the TFPN website. Who cares? It's like the information is out there. I mean, we're not kidding ourselves. Everybody can, not everybody, but you can do it in Excel. You can do it in Trading Box. I mean, creating a trend following trading system isn't the hardest thing in the world, but following that system and having the mindset and psychology to stick to it, this is what only a few people in the world, a few percentage of the people in the world can do, because it is so terribly inconvenient. It requires everything: consistency, patience, all the things which most people in this day and age have an issue with. They're addicted to change. They're addicted to the next big thing, the next news cycle, whatever. Here's the latest tweet. Here's. We're not like that. We're more like old school, sticking to the stuff that has worked, and we're changing very, very, very slowly, if at all, and only if we have evidence that the change makes sense. This is the key, to the things that we do, and I. The good thing about it is, every day that goes by, I feel more and more happy with that approach. Like, this is the best thing in the world. We haven't talked about dynamic position sizing today, but the other day I thought, if I had this thing going on, I'd be trading every day. There's something to do probably because the correlation or volatility has changed. And this morning, Clever Moritz and I, we were on Slack and we were going through the portfolio. And it's like, is it nothing to do? There's nothing to do. And we both ended it with a smiley. There's nothing to do today. No exits, no entries, nothing. So we'll go play tennis.
And I have mentioned for years that people are seeking a comfortable, maximum comfort in everything, a comfortable path and easy path. And after they are failing, because it's false path, after they fail in this false strategy that looked easy, they find another easy, the same false path and fail again and again. And they consistent only in this, in failing and believing in easy, comfort, profitable systems. Easy for them, but not shaping themselves to feel comfort in uncomfortable to most people circumstances. I think this is the biggest mistake, one of the biggest mistakes of the society.
Well, and this is also because there is always something new going on, right? I mean, now we have these zero DTE options. I just while we're on this space, there was an announcement that the Eurex has now launched zero DTE options on the Eurostoxx 50 index. They exist on the S&P 500. So here's the new thing, right? So people get focused on this and they think, oh, finally there is this magical way, this new product which I can now use to improve my performance, to come up with a new system, to make more money, to finally just let the money rain. I don't know. I usually stay away from these things for a long period of time and just observe. Like a patient, I'm lurking around, just observing. I have a hunch that, I mean, clearly this isn't just be raining money from the skies. Everything has, consequences, and there's certainly risk. So I just see what develops there, but I don't need to be. I never really need to be a participant in anything on day one. I think it pays to also be patient there and just let others be the pioneer. There's so many things that we can do with our trend following system. So many markets, trading speeds, methods to go in and out of trends, whatever it is. You don't have to be, chasing everything that is in the Wall Street Journal or the Twitter, and people get so excited about it. I think this is another thing that usually costs you money if you do that. You get too excited, you make mistakes, and it's a waste of time. You can spend your day differently. This is like, I just love this way we do things. Yeah.
So I was talking with one guy, and he was talking that crypto industry is magical. 1.5 years ago, in 2022, I think, as I remember, when Bitcoin was maybe near $60,000 for Bitcoin, and I said to him that all you're saying to me is against the logic of investments and against the loss of investments and against the loss of even the loss of nature. All your all your narrative is against real loss of nature. That this is something magical. It's only marketing tool when really these guys in firms, different firms and brokerage firms and banks, of course, yes, they say that there is a new magical tool that will bring you wealth in a very comfortable way without any knowledge, without any experience. It will, and people pay money. For example, that guy paid 500 United States dollars for the course of Bitcoin, for the narrative how magical Bitcoin is. But in fact, we must think deeper if we want to be really wealthy, successful. We must think deeper about the things, about this narratives, about this knowledge. Well, where is real knowledge? We must dedicate our time, pay attention, as I have said before. We must do our research, and of course, we'll have a reward for that.
I think that what would be interesting, I don't know if you're going to approach that, is how to measure the convexity of the prices themselves, right? Like the prices of the underlying assets, in your scientific approach to things. I remember seeing, I don't know if you remember the trend pod indicator, which was kind of, an attempt to measure things, in terms of how they trend, because I think that sometimes it's hard for people to see the way prices behave so that a trend following rule can be much better than anything else.
I don't actually look at the convexity of the underlying time series or Cordura. I don't measure their skewness. I mean, we do know, and I have analyzed this many years ago. That, for instance, equity returns are negatively skewed, etc. But this is not a requirement for me to enter or avoid a trade. Like, whether the underlying asset has displayed negative or positive skewness or a certain type of moments in its distribution is of no consequence to my trade. I will just take the trade. I have a protective stop. I have an exit and entry, a stop loss. Losses will be kept small, and then we'll see what happens. This is the underlying convexity of the instrument is really not relevant to me. It may be relevant to TransTrend. I'm not saying that there's no value in there. It's just I don't do it. We hear Quest speak about it a lot, like getting into markets that have or getting into trades that have a propensity of producing a more positively skewed trade result. Shorter term trading is what they do. They've attracted a lot of assets. No, it's just one observation. I shared it with Richard and Jared earlier today. They're, I think, down 12% or something like this year to date, which I found surprising. I hadn't looked at their returns, but I was expecting them to be positive, given the stuff that had happened with SVB and some of these reversals that we've seen maybe in the bonds there, that they would have caught this more profitably or avoided the losses to a greater extent than we did, but apparently they have not. So no, the skewness is, to me, really the skewness comes in the positive skew is the trade outside, the trading outcome. Like all my trade results, when you plot them, that is a very positively skewed outcome, which is a result of keeping losses small and letting profits run. That's great.
No, yeah, I meant, sorry. I know that all those things like the trend also are backward looking, so you cannot use them in real time. I was just asking Richard, because he said he was doing, like more of a scientific examination of the parts of the trend following strategies, etc. And I agree with you that the best way to look at it is to pass it through the rules, so you see the outcomes in terms of trade statistics. But I never saw a good way of describing why the prices themselves are prone to be, to be working in a better way in a trend following rule situation.
Yeah, look, one of the things is we can use more advanced methods to break up price data. For instance, we can examine time series data where we determine the trend components of it, the cyclic components of it, such as the mean reversion components of it, the noise and how that diffuses. There are nonlinear methods to analyse price, which industry is really sort of reluctant to take on, but I certainly know that a lot of the quants in the nonlinear space are looking more at the time series methods of analysis as opposed to the cross-sectional methods of analysis, and I know TransTrend are looking at the cross-sectional methods, which so what they're doing is they're looking at the core trends that float the boats effectively. So when they're assessing trends, they're looking at unique trends. What are the unique trends that are driving most of the markets? And so their analysis is basically a cross-sectional analysis looking at which are the primary trends in a cross-sectional way are lifting the other trends in the markets, and therefore they're focusing on those primary trends. It's almost like a relative strength measure that they're applying there, which, that sort of goes against the principle of how I trade, and I think how some sort of classics trade. If that helps.
Yeah, the trend pod thing that they use is just to explain after the facts, which I think, of course, is not useful for building something, but it's great for backwards seeing what you mean by having a price that can be used in trend following, and it's something that I don't see that much in any place.
Quite a bit of it.
Consistency, patience. He was talking about consistency, patience, the need to not jiggle with your models, only change them if validated over empirical data sets. That was the primary thrust, wasn't it, Moritz?
I don't think we're ever going to get. I don't think we're ever going to get away from this. Having to fight like every day and every week with trend trend following being used as crisis alpha and a small part of the portfolio, and convexity. And Harris was getting onto that again with a lot of things that we've not said in the way that he portrayed it, but I definitely look at it the way Moritz does. In fact, I tried to go as far as I could and just say, look, adding stocks to trend following, long and short, a lot of stocks potentially is just going to make the whole thing more of the perfect portfolio. And you don't need long equities, long stocks, and long bonds. In fact, you need to wrap trend following around all of those things. And so you can get all the assets or be worthy of getting them all, not just a small 5 or 10% allocation. And this kind of Stockholm syndrome, the idea that we're only on this planet to serve these masters. Please, master, give me 5 or 10%, and I will make my system a little bit worse. And but I know my place, and you're going to like me more if I kowtow to what you want my trend following to look like. And I think that getting away from that is going to be very difficult and impossible. But one of these days, and I think we're probably in those days now where trend following is going to shine, and it's going to be the best investment for certainly compared to long equities and long bonds. And they're going to miss the boat because could have been major asset gathering in the wonderful strategy if there would have
It's
been
not as
more.
if you haven't told them, Jerry.
Told them, I've shown them. I don't think that they, as I've said before on this podcast, on this spaces, I love going down those lists of stocks that I've chosen, and they're really fun stocks to be invested in and trend follow, and they make me giggle when I don't think they're giggling at all. I don't think that they care. I don't think they've even looked. So, but it is a great list.
You know what? I sometimes think there's no statistical analysis required, no math competency is really required. I mean, I don't have a 35-year track record, but you, Jerry, you have that. And people can see this monthly track record in the index on the databases, IASG and stuff like that, right? So when you look at this chart, which starts in the late 80s or early 90s and ends today, and you just optically look at it, just look at it, and compare this to the S&P 500, how can you possibly choose the S&P 500 over this return stream? It's nuts if you do. It is really great. I mean, just adjust for whatever it is futures. If you want to have it with a little bit more volatility, well then trade it with a little bit more volatility. If it is too hot for you, trade it with a little bit less volatility. But it is clearly just optically, without any math, without any drawdown statistics, no Sharpe ratio required, no calculations, nothing, just eyeballing it. It is the superior thing, and has nothing to do with crisis alpha, really. I wouldn't be surprised. There's a non-zero probability, and we can make a bet there. Really, at some point, we will, as trend following traders, fail to shine when the S&P tanks. historically, that hasn't really been the case, but it may not have been because of the S&P 500. We may not have been short the S&P 500. We were long bonds, and bonds and equities were inversely correlated, or we made money in crude oil, or it was a currency, or whatever it was. Now we have these diversified portfolios, but still there is a chance that something happens in the markets that is a major event where most portfolios will be down, pension funds will be down, the long only crowd will be down, the 60-40s will be down, the risk parity guys, everybody will be down. And maybe the CTAs will be down as well, simply because this is how the dice were rolled in our systems. We don't have the positions on. We're not short the S&P 500. We have the bonds wrong. We could also be down, maybe not down as much. And then you will read in the Wall Street Journal and the FT, CTAs fail at delivering crisis alpha, and here's another reason to drop them out of your portfolio. This crisis alpha thing has never been convincing to me. It is also too short a period, these crises. I mean, it's like I said before, I talked about patience. These 3, 4, 5, 6 month type of periods. If you are a trend following trader, you need to harden yourself to definitely be in a 6 or 12 month or whatever period where you're not looking very good. Others look better, but that doesn't mean you're doing the wrong thing. Don't hurt yourself too much by benchmarking yourself against the people that have the performance right now. There's always somebody that does better than you. But if you can stay consistent through these periods and stick to what it is that you're doing, then yes, it is this patience game. After a while, we'll come out of it. And there is also no lost decade. Jerry didn't have a lost decade. I didn't have a lost decade. I didn't even have a lost 3 years. Maybe it was a little bit more flattish. Okay, still made a bit of money, but it wasn't a lost decade. But it goes to show, I mean, for a period of time, you just have to be able to endure the pain. Doesn't necessarily mean that you need to be in a steep drawdown. Just you don't make money vis-a-vis others. Yeah.
Good morning, quantitative. What's going on?
Hey, Jerry. Good morning, guys. No, just listening to the gurus talk. I'm teaching an AI course now. I took a teacher role at a school, and one of the projects I'm doing is using GPT to come up with different stock portfolios that are very diversified. So I've been thinking a lot about your stock selection, Jerry, and stuff like that. And I don't know. I just reflecting on to go stock heavy, and I was blown away by some of the results from these. Just picking stocks sort of on a randomized basis, but based on sort of a thematic driven process, and the lack of intercorrelation within the equity asset class, I think, is oft overlooked. And I don't know. I'm just pretty. I feel pretty good about uh, the future for equities in terms of the trends that are going to be found in a sideways market. If we get that, I'm not prognosticating about the future, but I don't see it in bonds, and the intercorrelation and the different lengths, long-term bonds, short-term bonds, stuff like that. It's evaporating. So I don't know. I love the philosophy, and yeah, I don't have much to say right now, but I'm just excited about the change you made, Jerry, and yeah, I don't think it's going to be in the indices. It's going to be in the single names. That's all I got. But much love to you guys.
Oh, thanks. It's always good to hear from you. I think I think that Eric's product, where he puts half the money, or his position is 50% world stocks roughly, and then the other 50% of the portfolio is his managed futures.
Is that the
I
standpoint?
think
Is that the standpoint? Yeah.
Standpoint, right? So I think that's just a much different product, because I've noticed that I can have it both ways. If you go in and you really try to choose different stocks, and ones that are much different than others, and maybe smaller, and commodity based, but you're really trying to create a really diversified group of stocks, you're not going to be that correlated with the S&P, because you don't have those stocks. And then that index can be driven by just a handful of markets. And so I did too good of a job. I I tortured the stocks into behaving like the rest of the portfolio, which is they don't behave and they fluctuate all around. And some are in downtrends and some are in uptrends and some are flat. And so I don't have correlated performance on those 150 stocks to the S&P. So if the S&P and stocks have a big bull market, I don't know. I don't think I probably won't keep up with just a general increase in stock prices, like like maybe Eric's fund would. But because my goal was really that you will get this great diversification in trading equities. It is worth half your portfolio because there's 4,000 of them out there, and so that I think is going to be more likely that I'm going to have these outliers, as you said, in the midst of sideways action or whatever. It doesn't matter what the S&P is doing. Now, on days like yesterday, I pay a close attention, and I have all my stocks. I'm looking at them and their performance, and I throw the S&P in there, and the S&P was almost the worst performer of all of those 150 stocks. The S&P was the worst, performed worse yesterday than almost every single one of them, right? And then the day before, the S&P was one of the top performers because I'm just not doing the same thing. So you can't really have it both ways. If you're looking for diversification and really selling this idea that that the way to get diversification is to add equities, then you're going to, if you're successful, you're going to not be that correlated to the stock market. But on days when stocks are all down, obviously, almost all my stocks were down yesterday, and then almost all of them were up the day before. So you have these daily gyrations that, of course, when you put up a one-year chart, that the basic uptrend or downtrend doesn't really change. Go ahead.
Sorry, real quick. I just have like a benchmark set up with. I mean, Eric's fund has been working almost too well the last few years, and I just sort of look at your ETF, and I look at DBMF and all Dunn's mutual fund and stuff like that, and I've noticed, the same thing is that it's just behaving wildly different, and I think that's just a sign that you're tapping into something that's different. So anyway.
Yeah, and Mike Harris went on to sort of say, once again, repeating this idea that adding markets to trend following strategy dilutes potential gains from outliers due to smaller position sizes and leads to diminishing returns that promises slightly better adjusted returns in equity markets, but no alpha. So that, of course, we've debunked in the sense that adding markets doesn't dilute potential gains. The gains from any one of those individual markets is diluted because we're trading smaller as we add more markets. Not tit for tat necessarily, because we can trade actually larger overall by trading many markets. But we're going to rely on that about 10% of the trades will be outliers, and so we're pretty much just smoothing out that performance with more markets and decreasing the luck factor. I like that on that other that other paper I tweeted about the luck factor. You can have good luck and bad luck, and if the fewer markets you trade, the more susceptible you could be to bad luck and good luck, I guess. But this underperformance and how it's going to impact compounding was a pretty interesting idea. Adding stocks to trend following to increase the number of outliers diminishes its convexity potential or the ability to protect wealth during bear markets. Well, yeah, I don't think that's true. Adding stocks, no, we're trend following those stocks and adding stocks. And if you trade single stocks, you're going to be able to have on more shorts. There's more shorts out there. There's more stocks to short. And once again, we want to encourage people to sell stocks and buy trend following that trade stocks because it's a prudent allocation of resources to put to use trend following with your stocks and not have long only all the time, and with an allocation to trend following that hopefully will help during bad periods of stocks.
Also, last thing for me, sorry, Jerry, and I'll go to listener mode. But Rich, great podcast, man. I love that you're getting that. If you guys haven't already talked about it, great stuff there, man. Anyway, sorry.
Cheers, mate. Thanks very much. It's been a long week for me. I'm actually looking at this bottle of Johnny Walker Black in the distance, and I'm thinking to myself, I'm looking forward to the end of this week.
I don't. Can you classify the end of your week though as the end of the day, since you still are awake and you still have to put up with the U.S. and more of the European markets? So at least when 4 o'clock rolls around here, we're done. But I think when 4 p.m. rolls around for you, you're just getting started. Your day is you can't start your weekend until
Yeah, I've just got to
the
accept
S&P.
the fact that my Scotch drinking occurs at about 12 p.m. through to 3 p.m. when I'm preparing the Spaces production for the YouTube, and yeah, I usually manage to get about quarter of the bottle through by the end of that process.
Yeah, I I didn't. I quit drinking, and like 2 months ago, and I just came in one day and I said, okay, no more red wine for a while, and I didn't even think about it, but I'm thinking about it, and I'm going to start drinking red wine again because I love that, and I'm going to France soon, and so I'm going to reintroduce myself to some good alcohol, some good wine. But my health has improved quite a bit, so my workouts are so much better, and my sleep patterns are better. I had just had no idea that that this would occur, and so I am very motivated by health concerns, and doing my workouts and staying in decent shape for my age. But I am going to do it, and I think it's going to be on the flight over. I'm not even going to wait till I touch down in Paris. I'm pretty sure I'm going to go back to the red wine on the flight as we're taking off, if not before. So yeah, I do. I don't. I was going to say I miss it, but I don't really miss. But I'm intrigued by not missing and not this not being a bigger deal for me because I can't remember not drinking wine this long since I was in my 20s when I started drinking wine. So it is, but yeah, I get spooked a little bit by all the new articles. Like the new articles come out and say alcohol is not good for you. Like someone sent me an article yesterday saying that Biden's um, lead doctor is going to come out and say that 2 drinks a week is what we recommend now. And so I'm like, oh
Oh
crap.
my God.
Oh yeah. And then I had another family member tell me yesterday that their health issues, had some minor health issues, let's say, they were all cured by eating meat. And so I sort of quit eating meat as well. I mean, not that I don't ever eat it, but I don't order it. If if the bacon is in my salad, I'm okay, or something like that, or an appetizer. I just, throw it in my mouth. But so, yeah, so that is this. It's probably nothing more confusing and more contradictory than trading and diet and fitness. There are so many different scientists and supposed experts who contradict each other. So trading, diet, and fitness, two of the things I'm most interested in, because also I have, I don't know why I'm in this mode of giving things up, but I'm giving up fantasy football too. So I just decided I didn't want to do fantasy football. It takes up too much of my time, and intellectually, it's not challenging, or it's not what I want it to be. It's not as interesting as trading. Okay, but eating meat, I don't know. Maybe I should eat more meat.
Bring it on.
As soon as I mute my mic, you say something funny, and I start busting out laughing. Um, Okay. Anybody else want to weigh in? Oh, we have all these new listeners, new friends of mine on Twitter who never talk. Not absolute, for God's sakes. Oh my God. No one's ever going to say he never talks. But you guys are welcome to request to speak. My Twitter friends who remain silent. And all right, he's up on the
Hey,
stage. Is he going to?
what's going on, guys?
Well, give us your perspective. You're a long time monitor of this space.
Yeah, so Jerry and I exchange direct messages sometimes, and I usually try to just sit here and listen because I don't feel like I have as much to offer, but I have more to gain by just keeping quiet and listening. So I hope I haven't offended you, Jerry, by not coming up and speaking. It's just because whenever you guys get to talking, I don't want to disrupt the flow that you guys get into because you guys really are, espousing some very important information and ideas and rules of thumbs about markets. But as far as trend following goes, and being a divergent trader, it really is an interesting way to look at markets, and perceive strategy. I had no idea that that's how professionals kind of built their mental framework upon which they, perceive markets and build strategies. So I think that looking at it from a divergent and convergent perspective, that really just simplifies a lot of it, and you can kind of just, go from there. So I've really enjoyed listening to you guys. I've learned a lot, and I do have questions, but I don't want to bore you guys with my dumb questions.
Come on, D, hit us with it.
Well, you guys talk about max diversification, and I was just doing a little of my own research, and I was looking at groups like Two Sigma, and I was looking at Renaissance, and I was just curious one day. I was like, I wonder how many positions these guys hold. And when I looked at Renaissance, I saw that they had like 4,000 or 5,000 equity positions, and I think Two Sigma had like 3,000 or 4,000 positions, and I think Paul Tudor Jones had over 1,000 positions, and that kind of led me to this. Like this, the next thought was, you know, some of these guys, they run funds where they have like 25, 30 positions. I guess they consider that good diversification. I guess you guys wouldn't consider that the great diversification. Um, But I guess if you only have 30 positions, I guess the upside could be more, because if let's say you had 10 outliers to the upside and you only had 30 positions, I guess that year you could just have a massive performance. But you also run the risk of having a really bad down year, I guess. But having 1,000 positions or 4,000 positions, I guess what I'm asking Jerry is it better to have 1,000 positions than 300 positions? Because you're not going to have this sampling error effect. Like, let's say you had 300 equity positions, and you end up missing a lot of those outliers because you didn't own the whole spectrum. Like, is there like a
Well, I think you're. It's like I said. It's if you're using trend following. Some Renaissance doesn't trend follow, so they're probably not a good group to compare us to. But they're doing something entirely different. But let's say Paul Jones may be somewhat of a trend follower, definitely a position trader, and so I think that if your AUM kind of demands it, that you need to trade more markets because you're going to be a big part of every market that you're in, then there's no, certainly for me, if I had billions of dollars under management, I would want to trade more markets, more stocks. And so our idea from a trend following point of view is that like about 10% of those trades are going to be outliers. So you just multiply 10% times the number of markets that you're trading. So you're missing some outliers, you're getting other ones, but because you trade so many markets, your position size in each individual trade is smaller. But so basically, it's all equal, except you're just smoothing out the performance and getting more diversification by trading more markets. I would love to trade thousands of stocks, of course, or have a product that trades all the stocks. All stocks that are trend follow, all the stocks that are. Maybe that's my next ETF. We'll trade thousands and thousands of stocks, everything that we can get into that's somewhat liquid based upon our AUM and our position sizing. Trend follow them all, long and short, and that's a new one. That would be a new ETF. So,
Well, let
um,
me ask you this. Could it, I like some of the stuff that Michael posts, and I follow him. Think he's a really smart guy, and I think I got what he was saying. With more diversification, you get diminishing returns. But with the systems that you run, could it be that the more diversification that you have, you could have marginally improved returns because you will catch all the outliers? I think that's what I'm trying to say.
right. I mean,
Look,
it's diminishing returns on any one individual market.
Right, right.
Right, of course, but not diminishing returns on
Across the
the
board.
portfolio as a whole. Right. Go ahead, Richard.
yeah, so the diminishing returns, basically, the assumption is that the level of correlation benefits you get from diversification that has a function called the square root law, based on the number of markets. So now that assumption is built on the premise that the properties found in each liquid market are what we call homogeneous. So assuming that each market carries with them these homogeneous properties, the square root law does apply. But in our world of outliers, this is dealing with chaotic features of the market, which are unpredictable. They're not distributed uniformly throughout each market, and you can't apply the square root law. This is because outliers, so the example is, let's say I had 10 markets versus a portfolio of 100 markets. Which is better in terms of reducing selection bias in capturing outliers? So we don't know which markets are going to display these chaotic properties. It could be any of those markets, and they're not uniformly distributed across all markets because this nonlinear sort of chaotic features, which are these outliers, they're not distributed uniformly. They're based on principles, a bit like the butterfly effect. So small variations in a particular market can, at certain times, under amplification, produce these outliers. It's not something that can be statistically evenly distributed throughout a distribution. So the square root law falls down under that premise, and we find that selection bias is the most important criteria. So if you've got 10 markets versus 100 markets, 100 markets reduces your selection bias because in those 100 markets, wherever the outliers exist, and you might get multiple outliers in one return stream or one in one return stream and one in sort of every 10 return streams or whatever, they're not evenly distributed. So when you look at that, you see, well, there's selection bias if I'm selecting 10, because what happens if the 10 I select have no outliers in them? There is no sort of there's no sort of profit potential from that distribution, that trade distribution outcome. But under 100 markets, the nonlinear properties found with those outliers, the selection bias is significantly reduced, and you do find that your portfolio distribution of trade returns possesses these tail features. The impacts of those outliers in those 100 markets gets represented with this positive skew and this magnification property of your portfolio wealth. So you can keep this principle going to 500 markets, to 1,000 markets, to 2,000 markets. In our nonlinear world, it's a valid principle. But when people start thinking in terms of, oh, the square root law applies because the number of markets, we get a certain threshold, and then the marginal benefits of diversification decrease, they're not thinking in non-linear terms. They're thinking of uniform distributions. And this is where the whole premise of that foundation of diversification totally falls down.
Yeah, and I subscribe to that, and I'm very thankful that I found you guys and have had the opportunity to listen to you guys. It's really been great. And I listened to your first podcast, Mr. Richard. Really good stuff. And Mr. Moritz, I listened to Top Traders Unplugged. You were talking about warrants, and we can probably save that for another day. you were doing some type of warrant trading. Had me totally confused. It was talking about volatility surfaces, and I was trying to follow along. But maybe we could save that for another Sunday when we've got more time. But yeah, I just wanted to say I appreciate what you guys do. It's helping novice traders like me, understand how markets work and how to handle markets. Because left to my own devices, I'm doing pretty not good at it. So I really do appreciate listening to you guys.
Welcome. You're welcome back anytime. Especially, it's always helpful to hear questions from people who are learning and don't trade for a living. Because I get irritated when professional people who know very good and well what we're saying misrepresented or quote unquote forget what we say and leave things out. But I'm not that clear all the time. So for people who are new and wanting to understand trend following, I do take shortcuts and use words that are not that clear. So that's very helpful.
Jerry, can I ask you a
Thank you. That's it.
question?
Sure.
Have you seen this Meet Kevin guy? Have you heard of Meet Kevin? He's got a YouTube channel. He just launched the ETF, and I don't think he's got any professional money management experience. Are you familiar with this guy?
No.
Well, I think, he started a following on YouTube. He's kind of got his own TV show, and he launched the ETF. I mean, there's no telling how much money he made on YouTube. Probably millions, because he has millions of followers. And now he's launched the ETF, and I think his ETF, the ticker symbol's PP. I think it's got like $50 million under management. And I don't think that this guy has ever managed money professionally. I don't even know if he has any education in finance or economics. And I'm not trying to give advice because I'm the last person to give advice. But have you ever thought about using like the social media venue to sponsor your or advertise your ETF, like some of these social media personalities like a Logan Paul or some of these guys?
Well, I know we have a group of people who are working on promoting ETFs, and it's a lot of compliance, with ETFs and talking about ETFs and recording spaces and podcasts and how you're supposed to go about that. So I don't know that everybody follows that compliance thing like they should, but it is very intriguing to mix up, your products and your certainly something like an ETF with more social media, whether it be Instagram or YouTube or Twitter X. The one that you're talking about, is it Meet Kevin Pricing Power? Is that it?
That's it. Meet Kevin Pricing Power, and the ticker symbol's PP.
Yeah. How does he trade? Do you know?
I think he's like a value investor. He's more fundamentals. Companies that have good balance sheets. Have good forward looking expectations. I think he's a fundamental guy.
Okay, that's good. That's good.
And
I
he's
used.
he's a very he's a very look he's very astute. I mean, look at how well he's done for himself. A YouTube channel, million subscribers, done very well with that. Launched the ETF, managed to get like 50 million under management. And I'm just wondering, like, what kind of inflows could a big social media personality, if they sponsored an ETF? I just wonder what kind of inflows something like that could possibly generate. And I gave Meet Kevin as an example.
Right. Yeah. I see that. I see him now. So it looks like he has good performance. So that's good. I know we need to. Everybody who is on our ETF team is listening to this spaces, so they will figure this out for me. I am very fortunate that I'm only in charge of the trading. Although they would all say that I have very big opinions on very minute issues, which I do, uh, that I should stay away from those other issues that don't have anything to do with trading. But we have a great team of people who, number one, get it out there and if you want trend following plus nothing, if you want to trend follow stocks in that sort of niche product that is really something that's very unusual. And really, when you launch a product, you've read this over the years about people who've launched really great products, and people who launch products that don't go anywhere. I think they have similar characteristics, and that is no one really thinks they're going to do very much except the people launching them, and they get very excited about it, and no one really realizes that they like this idea or wanted this idea until it kind of comes out. So it is a bit of a risk to start something that's so different and not generally accepted as something that people kind of need. I love that quote from Eric where he said, "I'm trying to get people to want what they need." And I agree with that totally. Although we have different perceptions of what people really need, I suppose. Although Eric is the one who wrote the paper, does trend following work on stocks? And I'm just the one who still pays attention to it. And the answer is from him. The conclusion that he came to with his partner Cole was yes, it does. Okay, I'm going to go do my podcast with Mike Melosinos. Hopefully, I'm monitoring his work product today. Hopefully, he is producing what he is required to produce for me every day. And I doubt if we have many trades to do either. Just like Moritz, we're probably not going to do very much today. Although with 300 markets and 4 systems, you're always doing these really small trades, which really help psychologically. No trade, no position really by itself can screw with your performance too bad. But sorry for the late, sorry for getting on late today and having those technology problems. But I think I did learn that I can go and come back again, because I think I could hear Moritz when I got off of Twitter and then came back. So hopefully that works. All right. Thanks, everybody. Thanks, Richard, for recording all of this. We'll see you guys next week.